Welcome to the Investor Edge. Amazon is spending $200 billion in a single year to own the artificial intelligence future. But is it costing shareholders their current cash flow? That is the question we are asking today. Following their Q4 release, the stock plummeted 16% in a single week.
It is a classic calculated gamble, Mark. While they beat revenue expectations, they missed on earnings and issued a very disappointing outlook for the first quarter of 26. Today, we are going to learn if this massive infrastructure pivot is a visionary land grab or a dangerous depreciation trap.
Let us look at the numbers. Total net sales reached $213.4 billion. That is a 14% increase year over year. But the bottom line was messy. Earnings per share came in at $1.95. This missed the analyst estimate of $1.96.
And when we talk about earnings per share, or EPS, we are looking at GAAP numbers. That stands for Generally Accepted Accounting Principles. It is the standard way companies report profits. Amazon's operating income grew 18% to $25 billion. However, that included $2.4 billion in special charges for tax disputes in Italy and severance costs.
The real star was Amazon Web Services, or AWS. Growth reaccelerated to 24%. That is the fastest rate in over 3 years.
It is impressive, but the balance sheet shows a major shift. Free cash flow, which is the cash a company generates after accounting for cash outflows to support operations, collapsed by 71%. It fell to just $11.2 billion for the year. That is because capital expenditures, or CapEx, surged to $128 billion in 25.
Here's where it gets interesting, Sarah. There is a major disconnect between what management says and what the data shows. Let us start with the first discrepancy, the AWS growth story. Management says they are seeing massive reacceleration.
The data shows AWS grew 24%. But look at the rivals. Microsoft Azure grew 40% and Google Cloud grew over 35%. Amazon is the leader, but they are trailing in growth velocity.
Discrepancy number 2 involves costs. Management claims they are rigorously managing their cost structure.
The numbers tell a different story. They guided for a $1 billion cost increase in North America for next quarter. Between legal charges and satellite research, that efficiency narrative is getting buried by rising expenses.
The biggest red flag we found involves employee pay. Amazon relies heavily on stock-based compensation, or SBC. This is when a company pays employees with shares instead of cash.
This is the hidden risk, Mark. SBC reached nearly $20 billion. That is 174% of their reported free cash flow. Essentially, Amazon is funding employee pay through equity dilution rather than cash from operations.
If you are a short-term trader, here is the educational framework for the next few months. The stock is currently oversold. Its relative strength index, or RSI, is below 30.
For context, an RSI below 30 often suggests a stock has fallen too far, too fast. We see a structural floor at $190. Resistance, where selling pressure might pick up, is at $218. An entry zone might be between $195 and $205.
Now let us look at the long term. If you believe the bull case, the math looks like this. AWS maintains 20% growth through 2028. Their custom chips, like Trainium, displace NVIDIA and boost margins to 40%. If earnings hit $10.50 a share, a 28 times PE ratio gets you to a $294 target.
On the flip side, the bear case fears a hardware glut. If the $200 billion CapEx leads to permanent depreciation drags, earnings could stagnate at $7.60. At a lower 23 times multiple, the stock could drop to $175.
So, for growth investors who can handle volatility, this 16% sell-off might be a buy zone. But for value investors, you might want to wait for that $190 level. The key takeaway is that Amazon has abandoned its focus on efficiency. They are in a wartime expansion strategy to win the AI race.
It is a high-stakes bet. They are betting that their $244 billion AWS backlog will eventually turn into massive profits.
That wraps up today's deep dive on AMZN. If you found this analysis helpful, please like the video, subscribe to The Investor Edge, leave us a 5-star review, share this episode with a fellow investor, and follow us on Spotify, YouTube, and X. If you want us to cover a specific stock, please email us at opalfinancial1@gmail.com. We read every message. We appreciate your support, and that means a lot for us.
As always, this episode is for educational purposes only. This is not financial advice or a recommendation to buy, sell, or hold any security. All investments carry risk, including loss of principal. Do your own due diligence and consult a licensed financial advisor before making any investment decisions. This is The Investor Edge, produced by Opal Financial LLC. Please reach out to opalfinancial1@gmail.com for any questions you may have. Thanks for watching.